It's Friday. It's going to be another day of us taking a look at a big market theme and making it about inflation, because that's what John and I do. Rewards, and John Authers and I are going to sit here, Lisa Abramowicz, and talk about tech earnings, which we will make into inflation because it is related to inflation, but also because that's what the real story is. So let's talk, first of all, we got all those tech earnings. They were great. Not so much. Apple and Amazon came out, and it really was a macro story more than anything else.
Yes, I think, first of all, the fact that they're doing as well as they are doing tells you something about where we are in the recovery from the pandemic, i.e. not as far into it as we hoped we would. And the valuations that people are prepared to put on them is a sign of a very extreme version of duration. If we all remember our time value of money classes, the higher the discount rate, the less money in the future is worth to you. And people are getting used to the idea of valuing the future without any discount rate at all, only a slight exaggeration, which is why people are valuing Tesla at $1 trillion now, because they...
Hold on a second. I know where you're going with this. You want to talk about the potential for a bubble in tech stocks, right? Because you wrote a column basically talking about Tesla almost, how do we know if it's silly money, or how do we know if it's actually really worth $1 trillion in market cap? And your argument is that if you're expecting money to be free forever, think again. Is that basically your assertion, that people are not accounting for the fact that this may not be the normal forever?
Yes, I think that's there are versions of the future in which Tesla and Elon Musk was a great aficionado of science fiction throughout his youth, inspires him to this day. There are versions of the future in which you could look back and say, yeah, I didn't mind that Tesla was worth that much back in 2021. There aren't, but of all the versions of the future that we can see from here, most of them do not involve it being worth that much. In large part because a lot of the versions of the future involve moving away from the extreme low rates we have at the moment into a different economy than the one we've been living in for the last decade or so, or a different macro environment from the one we've been living in for the last decade or so.
Well, maybe if you need to look into the future, you just need to do so through virtual reality headsets, and you change your name, and then you'll be fine, and it's all meta and great. I mean, I do wonder, just quickly, if you want to touch on the whole idea of Facebook renaming itself to Meta for metaverse, and lots of mockery ensued from there. But there is a question of whether this is some kind of wholesale ideological shift away from social media into hardware, into something that could be the next frontier. I mean, what's your read on, parsing out the mockery from the reality?
Obviously, it's just such a cheap target. Resist the temptation. It made for half an hour of enjoyment. On Twitter is not normally a fun place to be. The first half hour after that name change came out, there was some amusement, some fun to be had on there. I think it shows, social media and the business model that works spectacularly well, particularly for Alphabet and Meta, as we now need to call them at the moment, isn't going to last forever. I'm sure they're right about that. And they're looking towards a future which is very intriguing, has remarkable technology in it, and which I personally find profoundly unattractive. I quite like to actually meet people in a field or on a hill or in a club. It's a real one, which does make, people will now just tell me to shut up, boomer, and all the rest of it. And then things get really out of hand when I explain that I'm not a boomer, and so on. Yes, there is a new paradigm. There is a new paradigm that is trying to find its way through. In many ways, you can see that in the fact that Amazon steadily has become much more of a hardware manufacturer. Even Microsoft makes quite a lot of hardware these days. That a lot of it does seem to be the fate of virtual companies to become real, and that's plainly going to happen to Facebook. Sorry, Meta.
Okay, hold on a second. No, please don't apologize ever for calling Meta Facebook. Please never again apologize. I will say that's a fantastic idea. This sort of virtual companies have been really forced, unfortunately, to become real after a while. I do wonder, going back to your point about the discount rate and how those assumptions are being severely challenged by what you called a hawkish dawn that is
Yes.
moving across central banks globally. Canada being the real shocker this week. How much, though, when you talk to analysts, and I get very conflicted views on this, do people say the markets are getting ahead of the Fed, the markets are getting ahead of the ECB and the Bank of England, versus central bankers don't realize what they're facing right now, which is a demand-driven shock in the United States that's driving a much more persistent nature of inflation?
I've certainly heard, and I'm sure you have as well, I've heard both those stories many times from people I take seriously and trust. They're not totally mutually exclusive, and they both have elements of truth. I do think that this is just classic marketry. Markets are efficient in the long term. Of course, they're not totally efficient in the short term. Something happens, and the market eventually gets it right after a series of adjustments. I'm not going to say that we have now efficiently moved to the right shape for the yield curve, because what's happened in the yield curve this week is extraordinary. The most, unless you count those few days last March when the bond market was truly broken, the biggest moves we've seen since the financial crisis. And they really, on their face of it, make no sense. That it's plainly to do with those battling narratives working their way through.
Hold on one second. What
Right,
makes no sense to you?
No, sorry. It makes no sense. There's no story about the outside world that can explain why the 2s-10s yield curve, which is the one that's most closely watched in the US, dropped from memory something like 30 basis points below 100 basis points on Wednesday. Sorry if I'm getting my chronology wrong. And then rebounded something like 15 in a matter of hours after that. That wasn't about news. That was about people realizing they were wrongly positioned, moving, realizing they got it wrong again, moving. That was that. Sorry. So in terms of the extreme moves, it's because people are realizing they have been wrong, and once they try to correct themselves, you unleash the kind of volatility we've seen.
George Saravelos of Deutsche Bank put out a really interesting note where he was talking about how it's a VAR shock, a value adjusted, value at risk shock. This idea of how do you price in central bank policy that is so uncertain? And that is what we are seeing, is a complete inability to do that. And these kind of wild swings really on the front end, because that's where a lot of the volatility happened, has been really stemming from this lack of ability to predict how central banks are going to react. And what I thought was so interesting this week was the ECB president, Christine Lagarde, tried to sort of push back against the expectation that the ECB would hike sooner than they've said that they would. She said, I'm not going to tell the markets what to do. I can't tell them if they're right or wrong. It doesn't fit with our projections. And people were like, well, that's not enough for us. We're going to go with our projections, and you can keep talking to the wall. I mean, this was essentially the message, and you continue to see front end rates go up.
It was interesting. I felt, obviously Christine Lagarde last year, her comments about "I'm not here to close spreads." She had, as is often the case, some bad miscommunications with the markets in her opening months. I felt a certain degree of sympathy for her this time. The ECB has made two of the most blatant hawkish errors in recent history. They raised rates in 2011. They raised rates in the summer of 2008. So help us. That was under Trichet, not under Christine Lagarde, but it's still, that's part of their institutional history, that people don't trust them. They think that if there's a hawkish error going to be made by somebody, it's out of the ECB. And I think she may be trying to overcompensate to get people to calm down, that no, we're not that mad. German break-evens have shot up, but they're still below 2%. So you just because they're no longer predicting prolonged slump in the US in the Eurozone doesn't mean that they're actually predicting a really strong expanding economy.
Yeah. Meanwhile, I got to say, the other thing that was fascinating, just to sort of tie up the hawkish tilt, we saw a 150 basis point hike from the Brazilian central bank this week as well. And I look at that and I say, well, is that helping? And the answer is not really. Like, these hikes that you're seeing in the emerging markets complex are not causing money to go into those nations from international investors, which really raises a question of what type of crisis could potentially emerge in the developing world, where you don't have robust, synchronized growth, global recovery, and you have pockets of real distress, especially from non-commodity producing nations. And I do wonder how this plays out, considering the international financing that has gone into some of these countries.
Well, that I completely agree with you. I think the other one that particularly concerns me is the contrast between Brazil and Turkey.
Yeah.
Turkey. That's. I mean, the author of their own misfortunes to a great extent, but Turkey is cutting while others are hiking. In the case of Brazil, had true hyperinflation. It's a word that's overused, but Brazil did have hyperinflation as recently as the 90s. It had its Selic, their central bank rate, dropped below the current rate of inflation for the first time ever early last year. That massive hike this year leaves the Selic still 3.5 percentage points, I think, below the rate of inflation. I mean, it's totally inadequate to catch up with the rate of inflation, with the dynamics that are in place. So, yes, I agree. The emerging markets are are almost in a different space. Just getting back to George Saravello, so you mentioned Deutsche, he has another note this week where he refers to this as being a Bretton Woods moment.
Yes.
By comparison with 50 years ago when Nixon pulled out of the gold standard. There is a similar sense of people really no longer believed the gold standard by the time Nixon pulled out of it. There is this moment of, do people really believe central banks at this moment? We've had such a long period when they've desperately tried to tell us they're not going to raise rates ever, and people have believed them. How can we now reconnect to a new reality? This is, and whether it's a Bretton Woods moment or an Emperor's New Clothes moment, but there is a lack of connection between the market. You're looking at me strangely.
I'm not. I'm just. Okay. I apologize for making faces.
Sorry.
But I think I make faces, which is unfortunate for someone who has a career on television. I will just say that it is, something that I have been watching in terms of believing the Fed that doesn't know whether to believe itself because it doesn't have a crystal ball into the economic data. And to me, I would say the most underplayed data point of the week, or probably the important data point of the week, was what came out today, 8:30 a.m., the employment cost index.
Yes.
This, to me, had a red bell around it. Basically, the idea that wages are rising, according to this index that the Fed watches closely, at the fastest pace on record in data going back to the 1990s. This is something the Fed will take notice of ahead of their meeting. This has stickiness. You see rents going up pretty dramatically. You see consumer prices across the board broadening out in their increases, and you see wages going up at an accelerating pace. How does the Fed?
All these years. It's what we've been wanting all these years.
I mean, this is not. We've moved from disinflationary to something that is more sustainably inflationary, with a market that can't really handle that. It is not built.
And with valuations, as we were saying with Tesla, that the whole market is based on the notion that you don't have to discount the future at all, only a slight exaggeration. Now we're going to have to start discounting the future. We're going to have to start charging people to borrow again, and those skills are actually beginning to atrophy after a decade, and the potential for accidents is very great. You just need to look at some of the moves we were talking about in bond markets this week. The potential for accidents, for people to lose money somewhere there, is very, very great.
Well, we'll have to pick this up again next week. There's so much more to talk about, including the fact that stocks have actually shrugged off most of this, including all the volatility in the short-term rates, which was kind of shocking. And then also we have seen incredible earnings, so it's easy for people to look past it. But there's so much to talk about. We'll talk about it next week. We'll make it all relate to inflation again, I'm sure, inevitably again.